for joining us today for the OECD's Economic Outlook for the World Economy, with a special focus on Southeast Asia. Before we begin, I'd like to inform you that there will be a question and answer session at the end of the presentation. If you have any questions for our experts, please put them into the chat. The presentation will be structured into 4 parts. There will be the Global Outlook presented by Isabel Casque, Deputy Director of the Economic Department's Country Studies Branch. The Regional Outlook for Southeast Asia will be presented by Jens Arnold, the head of our Southeast Asia division. Next will be the Economic Outlooks for the countries of Indonesia, Malaysia, the Philippines, Thailand, and Vietnam, presented by our senior economists Cyril Schwellnus and Philip Hemmings. Then comes the question and answer session. Now I'd like to turn the microphone over to Isabel Casque.
Thank you very much, Laura, and a warm welcome to all participants also from my side. Global growth has continued at a resilient pace this year, driven by the front loading of trade in anticipation of higher tariffs earlier in the year. Also very strong AI investment, particularly in the US, but also in a couple of other countries, and also supportive macroeconomic policies, both on the monetary side and the fiscal side. However, our outlook that we published yesterday highlights a couple of key fragilities on the horizon, from elevated trade restrictions to related policy uncertainty and concerns about supply chain security, to rising public spending pressures from increased defense requirements and the rising economic and fiscal impacts of population aging. And of course, there are also vulnerabilities associated with high financial asset valuations, such as for AI investments and cryptocurrencies. But I will talk a little bit more about that later on. Here on this slide, you see our growth projections. We now project global GDP to grow by 3.2% this year, which is only slightly below the 3.3% rate achieved in 2024. For next year, global growth is expected to moderate to 2.9%, as higher tariffs in the United States and in China raise business costs, reduce growth in trade and investment. For 27 then, we project a small rebound in growth to 3.1% as the impact of higher tariffs passes and inflation declines. OECD countries are growing at around half the rate of global growth, while economic convergence elsewhere, especially in emerging Asia, remains the main driver of global growth. Next slide, please. Activity in the technology sector has been strong, boosted by sharp rises in investment in AI and other digital technologies, as I've mentioned. On this slide here, you see industrial production. And as you can see, industrial production of computer and electronic products has increased much more than total industrial production across countries and regions. Next slide, please. Fiscal and monetary policies have also helped sustain activity. OECD countries' primary deficit, that is, government's fiscal deficit excluding spending on interest payments, continues to be significantly higher than in 2022, as you can see in the panel on the left-hand side. Monetary policy at the same time has eased in most advanced economies over the past year. This has lowered bank lending rates for firms and households and thereby supported credit growth, that you can see on the right-hand side panel. Yes, this slide, please. Here you can see the average legislated tariff rate on merchandise imports to the United States in the orange line. We estimate this average tariff rate at 14.9% in November. This is markedly higher than the 2.3% that we still saw in January, but it's lower than the 16% in September as a result of several new trade agreements. The full effects of these higher tariffs since the start of the year will become clearer as firms start to run down their inventories that they built up in reaction to the higher tariffs or to the tariff announcements early in the year, and also as the higher tariffs are fully implemented. So far, our estimate of the tariff rate that is actually being applied in the United States, that's the blue line, based on the latest available reported customs duties and import statistics, is below the legislated rate. So the blue line is below the orange one, and this suggests to us that tariff collections are likely to rise in the months ahead. Next slide, please. Here you can see the situation on the labor markets, and labor markets continue to be relatively tight, even though there are some signs of easing. Job vacancies have fallen back to their pre-pandemic levels of 2019, but still the unemployment rate across the OECD was 4.9% in the second quarter and 5% in September, so only slightly up from the record low of 4.8% that was reached in June 23. Next slide, please. In the United States, here on this slide, you now see all of our predictions for the various G20 economies. And in the United States, growth is expected to slow from 2% this year to 1.7% next year as higher tariffs take full effect. While for 27, we project a small pickup to 1.9%. For Japan, we project robust growth of 1.3% this year, then 0.9% in both 2026 and 2027, supported by resilient domestic demand. In the euro area, growth is projected at 1.3% this year, then 1.2% next year, and 1.4% in 2027. Here we expect that increased trade frictions are offset by capital spending related to the Recovery and Resilience Facility and also higher defense spending. China's growth is projected to slow from 5% this year to 4.4% next year and then 4.3% in 2027. This is a result of higher tariff rates on exports to the United States, but also continuing adjustments in the real estate sector, as well as fading fiscal support. Next slide, please. Inflation is expected to continue to decline gradually. For the OECD as a whole, we project inflation of 4.2% this year, followed by 3.5% next year, and then 2.8% in 2027. One exception here is the United States, where we expect that the tariffs will push up inflation from 2.7% this year to 3.0% next year. But then by the middle of 27, we expect inflation to return to the central bank's targets in most major economies. Next slide, please. This outlook that I just presented remains fragile, with significant risks. And here you see one major risk that we're monitoring. Obviously, the outlook for trade and trade policy is particularly uncertain. On this slide, you can see import restrictive measures on goods introduced since the beginning of 2009, and they are now estimated to affect 16.8% of world imports, up from 0.6% in 2009 and 2.8% in 2016. Additional trade barriers would obviously lower growth prospects and likely push inflation higher in those countries imposing such tariffs. But of course, on the upside, measures to lower tariff barriers and reverse tariff increases would improve sentiment and thereby support activity. Next slide, please. Another key concern is the resilience of global supply chains, given the high level of concentration and production of some key inputs, including rare earths and also critical minerals. On this slide here, you can see the share of China in the production of rare earths and critical minerals. And as you can see, the country accounts globally for more than 50% of all rare earth mining and lithium, and more than 90% of all magnet manufacturing and graphite. A sudden disruption in the supply of these key inputs could lead to output drops in a couple of key sectors, such as energy, information and communication technologies, including AI, but also defense and automotive. Next slide, please. Higher spending needs arising from defense requirements and population aging are increasing fiscal risks. NATO countries plan to raise their core military spending to at least 3.5% of GDP by 2035. And on the left-hand side panel, you can see our projections for a couple of OECD countries. At the same time, population aging is set to increase old age dependency ratios across the OECD, as you can see on the right-hand side. Projections suggest that the ratio will increase from 33 adults aged 65 and over for every 100 people of working age today to 52 in 2050. So from 33 to 52, that's a significant increase with enormous economic, social, and fiscal implications. This year's OECD Employment Outlook estimates that the fall in employment due to population aging will reduce the level of GDP per capita in 2060 by 14% under current policy settings. Our assessment is that the decline in economic growth due to population aging would cause tax revenues in 2060 to be around 14% lower than they would have otherwise been. And of course, on top of this comes, additional spending pressures on pensions, health, and long-term care. Next slide, please. Another risk refers to financial markets. Asset valuations, especially of US technology companies, are very high, reflecting strong optimism about AI and its potential productivity gains. Since 2020, forward earnings have risen 3 times as fast in the technology sector as in other sectors, as you can see here on this slide. If these expectations materialize, economic growth could be higher than in our baseline projections. However, in contrast, if these gains from AI are smaller than expected or are delayed, sharp asset repricing could occur with ensuing repercussions on the real economy. Next slide, please. The size of non-bank financial institutions, like insurance corporations, pension funds, hedge funds, and investment funds, has risen significantly over the past decades, as you can see on this slide. Some of these institutions, including real estate investment trusts and business development companies, are both highly leveraged and less regulated than banks, making them vulnerable to shocks. Next slide, please. Another risk that I would like to mention is the use of cryptocurrencies, which has increased sharply in recent
Isabel, you're muted.
Sorry, press the button. No, what I just said is that the transaction volume of stablecoins more than doubled between 2023 and 2024. At the same time, stablecoin issuers have become major holders of US Treasury bills, as you can see here on this slide. So a potential market disruption or turn in investor sentiment for cryptocurrencies may lead to a sell-off of Treasury bills, straining government bond market liquidity. Let me stop here, and I would like to pass on to Jens Arnold, who will talk a little bit more about the prospects and risks for Southeast Asia.
Okay, thank you very much, Isabel. So for Southeast Asia, the story is really one of remarkable resilience that we have seen during the first half of this year. We can move to the next slide. We see our growth projections for the region. So growth in Indonesia, Malaysia, the Philippines, Thailand, and Vietnam has remained solid, and in fact, much better than what we expected when we published our last edition of the OECD Economic Outlook. And this is despite considerable headwinds and uncertainty, first and foremost with respect to changes in US trade policy, to which the region is particularly exposed. For the aggregate of these 5 Southeast Asian economies, growth is expected to be 4.9% this year, followed by 4.5% in 2026 and 4.8% in 2027. This remains considerably stronger than growth in the OECD area, and it also exceeds OECD growth projections for the Chinese economy, as we can see in this chart. Now, there are, of course, region-specific risks around this projection. Particularly, the region is more than others may be exposed to geopolitical tensions or new tariff hikes, but there are also more domestic risks associated to the financial sector and to debt vulnerabilities. If there were new sectoral tariffs, for example, on semiconductors or tariffs on transshipments, however those would be defined, this could affect economies in the region particularly strong. In the next slide, we see that inflation has been mostly low across the region, to some extent helped by moderate food prices. Our projections see inflation increase a little bit in 2026, as you can see from the green stars here. But even that will not change the overall picture of only moderate and well-contained inflationary pressures. Hence, monetary policy has some room for providing further support if that were needed. For example, if some of those downside risks that I just mentioned were to materialize. In fact, Indonesia, Malaysia, the Philippines, and Thailand have already eased their monetary policy, while Vietnam's monetary policy stance is also in accommodative territory. Next slide. With respect to fiscal policy, the room for policy support is certainly more limited in Southeast Asia. We see on this slide the budget deficits of countries in the region, and they are already high in Thailand, in the Philippines, and in Malaysia, implying a need for fiscal consolidation. Now, of course, seeking efficiency improvements in public expenditure should naturally be a first part of every consolidation effort. But we also observe that Southeast Asian economies have generally low tax intakes, which in most cases will be insufficient to face the medium-term spending needs that are arising from population aging and from climate change-related challenges. In the next slide, we see that public debt is also on the high side in some economies, particularly in Malaysia and in Thailand. And they are approaching the limits of what one might consider prudent, particularly when you take into account that these economies tax relatively little and that they are exposed to volatility in international capital markets. In the next slides, we see some of the good story. So exports, which have traditionally been driving Southeast Asian growth, have so far held up really strong during 2025, at least in the part for which we already have hard data that we can observe. Of course, front loading is part of that story, and that should be starting to fade as new incoming data arrive. But the rising demand for IT equipment in the context of the AI boom that Isabel mentioned is likely to last a little longer. And on the next slide, we see that Southeast Asian exports to the United States have been doing well in relative terms, as the market share of Chinese exports to the United States declined by around 4 percentage points between January and July of this year. Southeast Asian exporters have been able to pick up most of that. In fact, 3.7 percentage points of those 4 percentage points. And in the next slide, we see that these changes have particularly been beneficial for Vietnam and for Thailand, who have been able to achieve significant market share gains with respect to exports to the United States. Now, on the next slide, we see what is maybe the most important element for Southeast Asia right now. And the overall message here with respect to tariffs is that the prospects for tariff rates are now much less frightening than they were during most of 2025. In this chart, the dark blue bars show the current effective tariffs, which are now, of course, the fruit of a round of bilateral negotiations with the United States. These tariffs are now visibly lower than they were in August 2025, although they are, of course, still higher than prior to the April 2 tariff hikes. For Malaysia, the bilateral tariff deal could even imply further tariff reductions once it is ratified, and this is the small dotted bar that you see for Malaysia on the right-hand side. But it's also interesting to look at how these tariffs have evolved relative to major competitors, and that of course includes China. While Southeast Asia had first an enormous tariff advantage over China during part of 2025, this relative advantage has now become smaller, and in fact it has declined to less than 10 percentage points, lower than it was before April 2. Relative to each other, however, the competitiveness of those 5 Southeast Asian countries has not changed much, with most countries now in a reasonably narrow range around 15% of effective tariffs. New tariffs are therefore unlikely, or these new tariffs that we have now are therefore unlikely to trigger sizable relocations or reconfigurations of value chains. For Malaysia, there is scope for things to improve a little further once the recent bilateral agreement has been ratified. Now, on the next slides, we want to go a little bit into domestic developments. Because, of course, tariffs and global developments are not the only factor driving growth and export prospects. There's also a lot of things that economies in Southeast Asia can do themselves to improve their competitiveness, which has to some extent taken a hit during 2025, at least when it comes to US market access. Southeast Asian economies are generally very open to merchandise trade, but regulations remain comparatively stringent when it comes to domestic competition. This, in fact, has not always been a policy priority in the region, and competitiveness has often received much more attention than competition. This situation is reflected in the OECD product market regulation indicators that we see on this slide, which measure the extent to which regulations restrict competition, whether wantedly or unwantedly. What we see here is that both Indonesia and Thailand, for which we have recent data available, have fairly restrictive product market regulations that often hamper market entry and competition, which in turn holds back productivity growth. For the Philippines, preliminary evidence also suggests that there is significant scope for improvement. In the next slide, we see that many of the current barriers to market entry are in fact concentrated in services sector. This shows the services trade restrictiveness index of the OECD, for which we have available data for all of our 5 Southeast Asian economies covered in the economic outlook. The emergence of competition that advanced economies have seen over recent decades has in fact yet to happen in Southeast Asia. Evidence suggests that competition in services has many beneficial effects, including for manufacturing competitiveness, as services are often less tradable, and domestic producers are forced to source many of them domestically. Widespread state ownership, for example, of large players in the services market is one element that can create an uneven playing field and hold back competition in services. On the next slide, we see that skills, which are also a very important ingredient of productivity and competitiveness, also have scope for improvement in the region. Tertiary attainments can be improved in Southeast Asia, with the Philippines a noticeable exception. Vocational training and degrees, which are shown in the green bars here, which are very important for manufacturing productivities, have been underused in the region relative to OECD economies and thus present significant scope for expansion. And on the next slide, we have put together some data on the coverage of social protection, because another way to enhance resilience towards global development is to rebalance demand towards domestic sources, in particular consumption. And for this, strengthening social safety nets would be one way to move forward. Overall, the region has still weak social protection frameworks, with pension coverage low in Indonesia, Malaysia, and in Vietnam. But even in countries where it is larger, which includes, for example, Thailand, benefit levels are often far below what is needed to prevent old age poverty. So summing up, while Southeast Asian economies have shown a remarkable resilience during 2025, there is much more that they can do to make their growth even more resilient, inclusive, and sustainable. And with this, I'll pass it back to Laura. Thank you.
Thank you, Jens. Now we turn to Indonesia with Cyril Schwellnus.
Thank you, Laura. So in Indonesia, growth is broadly stable. Consumer demand remains remarkably resilient. Exports also remain strong, and government consumption has recovered after spending cuts in the first half of the year to finance priority projects such as the Free Meals Program and the creation of a new sovereign wealth fund called Danantara. But we're seeing more caution in investment. So fixed investment is stable, but in the third quarter, there were large inventory drawdowns as businesses reassess conditions. So overall, we project growth of 5% in both 2025 and 2026, with a very modest pickup in 2027 to 5.1%. Inflation remains contained, was 2.7% in November, which is significantly higher than the average of 0.6 in the first quarter of the year. But this mainly reflects the phase out of a temporary electricity price discount at the beginning of the year. Overall price pressures remain contained. Core inflation, which excludes volatile food and energy prices, is around 2.5% over the past few months. And this is really just around the middle of the central bank's target band. We see room for the central bank to provide additional monetary easing to support economic activity, but we would suggest, the central bank needs to remain data dependent, especially given the recent depreciation of the currency to maintain inflation within the target band. Looking further ahead, so beyond the business cycle, we identify two critical areas where structural reforms could significantly boost economic efficiency and living standards. One is foreign investment liberalization. So we see that recent reforms have made progress in this area, but we think there are substantial opportunities to attract more international capital and expertise, especially removing remaining barriers to foreign equity ownership in telecommunications and transportation would enhance competition, boost innovation, and also accelerate economic modernization. A second priority is to improve public spending efficiency. That includes better cost control and improved targeting of social programs, including the new free meals program or the expanded free meals program. So to target them more and better to vulnerable segments of the population. So I'll stop here, Laura, and give the floor to the next speaker.
Thank you, Cyril. Next, we have Malaysia with Jens Arnold.
Okay, in Malaysia, growth has been strong, accelerating to 5.2% year on year in the third quarter of this year. And this has been largely driven by investment and consumption. Now, consumption has been underpinned by a strong labor market, as we see in this chart here, with unemployment at 3%, which is the lowest level since 2015. Participation in the labor market, in fact, is currently at an all-time high. Investment has been driven by tech sectors and by green energy, and the new US tariffs will be particularly favorable for prospects for this looking into the future. Against this background, we see GDP growing by 5.0% in 2025, 4.4% in 2026, and 4.1% in 2027. Inflation has been well contained at 1.3% in October, helped by food prices. In fact, core inflation has been at 2.2%. Inflation is set to rise amid wage increases, but also higher sales taxes and reductions in fuel subsidies. But at the same time, inflation will continue to remain at very comfortable levels. Looking at policy priorities into the future, we see that there is scope to reduce regulatory barriers to competition, such as entry restrictions, price ceilings, administrative burdens, and also by leveling the playing fields between private companies and state-owned or government-linked enterprises. At the same time, there is also scope in Malaysia to improve skills and particularly to reduce the mismatches between the skills that graduates have and those that are demanded on the labor market. That would boost not only growth, but at the same time also social inclusion. Finally, there is scope to reduce gender employment gaps by improving female labor market participation. And one way to foster that would be by investing more in childcare support. That's it for Malaysia.
Thank you, Jens. Now we go to the Philippines with Cyril Schwellnus.
Okay, thank you, Laura. So in the Philippines, growth momentum has weakened recently. So private consumption, as in many other Southeast Asian countries, remains resilient despite the disruptions that we've seen in the third quarter that were related to typhoons. Exports are also growing at a healthy rate despite higher US tariffs. But investment has slowed markedly. And that is actually due to a sharp contraction in public construction due to a corruption scandal linked to public works, with government construction really collapsing 26% year on year in the third quarter. The bottom line of our forecast is that we project growth of 4.7% in 2025 now, which is lower than our previous projections, 5.1% in 2026, before growth picks up to close to trend growth in 2027, so to 5.8%. Inflation has fallen in the Philippines. Headline inflation was 1.7% in October, below the central bank's target range of 2 to 4%. But this decline partly reflects lower food and energy costs, rather than very low overall price pressures. Overall, we think the picture for inflation suggests that there's room for the central bank to further reduce policy rates to support activity. Now, looking further ahead, policy reforms are needed to boost productivity and living standards. We have identified two critical areas in the Philippines. One is barriers to competition in electricity, telecommunications, and transport. These could be further reduced, which would lower costs for businesses and consumers while encouraging private sector investment. A second priority that we see is to reduce non-wage labor costs and update or modernize employment regulations, which would make it easier for businesses to create formal sector jobs. That would expand opportunities for workers, strengthen the labor market, and also strengthen the foundations for economic growth. Thank you.
Thank you, Cyril. Now we move to Thailand with Phil Hemmings.
Hello. For Thailand, we're seeing very much a similar picture for Thailand as has been described in general for Southeast Asia by my colleague Jens. First, the Thai economy was surprisingly resilient in the first half of 2025, more resilient than we were expecting in our previous OECD economic outlook. Second, the landscape of tariffs is looking to be less disruptive than we were expecting a few months ago. And thirdly, inflation remains relatively low. This is in part due to low food and energy prices in Thailand, but also we would note that core inflation is also low. Broadly speaking, we view the inflation picture as a positive one without a risk of a deflationary cycle. However, against these positive points, the Thai economy is slowing. The third quarter of this year saw growth fall by 0.6%. And also, we're seeing continuing downward trends in consumer and business confidence, as shown in the chart. Both of these indicators are in territory which shows that the majority of respondents to surveys think that the economy will weaken further. So with all this in mind, we see the Thai economy shrinking to 1.5% in 2026 compared with 2% in 2025. However, we do see a recovery in output growth in 2027 as the effects of the negative effects on the economy of tariffs tapers off. In terms of policy priorities, similar to as described by my colleague Jens, Thailand is among the countries where we support a structural increase in fiscal revenue, firstly to help ensure that the public debt burden is stabilized, and second, to enable the Thais to address various spending pressures related to population aging, including on pensions and health. A second policy priority that we'd emphasize is that Thailand needs to look towards raising growth potential. And it can do this partly by making regulation more conducive to increases in investment and productivity. Again, this was indicated by my colleague Jens in the chart on the product market regulation indicators. Thank you very much.
Thank you, Phil. Now we have Vietnam with Jens Arnold.
Okay, in Vietnam, growth has been really strong and moving at a pace of 8.2% year on year, which is the same kind of growth momentum that we expect for the year 2025 as a whole. And growth has really been strong across all different components of demand. First of all, consumption has been strong due to a strong labor market, and we expect that it will remain strong as real wages and employment continue to increase despite a temporary dent from a VAT rise that we now expect for the end of 2026. Investment has been strong due to strong public investment and favorable financial conditions. And exports have been supported by strong demand for IT equipment, both to the US and to China, as we see in this chart here. Against this background, we expect GDP to grow by 8.2% in 2025, by 6.2% in 2026, and then 5.8% in 2027. Inflationary pressures are projected to emerge amid the strong domestic demand, and there may be upside risks to how much inflation could rise. Monetary policy should certainly stand ready to withdraw support and should be watching inflation developments very carefully. Fiscal policy has been supportive through public investment, but in the medium term, it should move towards a more neutral fiscal policy stance. In terms of policy priorities, we see that Vietnam has scope to strengthen the monetary policy framework, and that would in turn allow stronger competition in the financial sector. This has to do with the conduct of monetary policy, where we think that moving towards a more price-based monetary policy would be more beneficial than the current setup where monetary authorities have credit targets for individual banks. And this has been described in our recently published economic survey of Vietnam. Beyond that, we also see scope to accelerate the rollout of renewable energy sources in the power sector to make Vietnam's growth more sustainable and at the same time to bolster energy security. And that's it for Vietnam.
Thank you, Jens. Again, I invite anybody in the audience who has a question for our experts to add it into the chat. For the first question, it deals with Indonesia. Can fiscal consolidation coexist with costly programs like free meals?
Okay, so I think in Indonesia, public debt is, as Jens showed, is actually lower than many other countries in the region. It's around 40% of GDP, so that's at a relatively prudent level still. The government.
Cyril, you're hardly hearable. Can you?
Yeah. Okay. Sorry. So public debt is relatively low still in Indonesia. And the government has also returned to fiscal rules. So we project for 2025 and the following years that the fiscal deficit will remain below 3%. So this is all good development. So overall, we think the fiscal situation is totally manageable in Indonesia, but balancing fiscal prudence with inclusive spending. So, for instance, the expansion of the free meals program, which is very ambitious, will require mobilizing more revenues. The tax to GDP ratio in Indonesia is very low. It's around 10%. And we think, to reach all, or to achieve all the government's priorities in terms of public investment, of an expansion of social programs, there needs to be more revenue mobilization. So taxes will need to increase at some point.
Our next question is on the Philippines. How significant is the impact of this corruption scandal on the OECD's economic forecast for the Philippines?
Okay.
For this year and in the coming years, and does it weigh on the outlook?
Okay, so what we know about the corruption scandal is that it has actually also already weighed on economic activity in the third quarter of 2025. And the channel through which it has weighed on activity is public construction, which has collapsed in the third quarter. So that's a big hit for the Philippines. We were expecting much higher growth in the third quarter, and this lower growth will bring down annual growth for 2025, but also annual growth for 2026. Now, the question really is for the forecast whether and how quickly public investment will rebound and how quickly also investor confidence will rebound. And in our projections, we assume that the corruption scandal will be resolved relatively quickly, and with the restoration of more transparent procurement, public procurement. And if that is the case, indeed, we see growth gradually returning to trend in our projections. Thank you.
Thank you. The next question is more general. Could you elaborate a bit more on the background behind the tariff advantage in Southeast Asia over China now becoming smaller?
Okay, so this is essentially just an observation that we're making. We see that before the April 2 tariffs, the differential between tariffs on Chinese exports to the United States and Southeast Asian exports to the United States was larger than what it is now. Then it has skyrocketed over the course of this year. And now we are back to something that's relatively small. To what extent that will have concrete implications on the relocation of value chains is something that remains to be seen. But we definitely see that the tariff advantage is smaller now than what we've known it to be in the past.
Thank you. This one is for Indonesia. For Indonesia specifically, what can the government do to increase tax revenues, which are currently still under pressure? Is it necessary to introduce new taxes?
In Indonesia, Laura? Did I get that right? I can't hear you, Laura.
Yes, it's Indonesia.
Okay. So, in terms of raising revenues in Indonesia, I think the issue, really, the objective should be that we find a way of financing the government's priorities in terms of public investment. So, improving infrastructure and improving, the health and education system through increased public spending, which we think is necessary. So we think, the objective, for instance, of the free meals program is sound. Okay, so you want to improve nutrition of young children, reduce stunting. So these are all very good objectives. Infrastructure is still substandard in many parts of Indonesia. So these are very good objectives. Now the question is, how can you fund these priorities? And one way to go would be to increase, the deficit, the fiscal deficit, accumulate more debt. But we think, fiscal discipline has actually helped Indonesia over the past decades and to stabilize the macroeconomy. So we wouldn't go down this route. And we think, debt levels are broadly okay, but we wouldn't want to have higher debt in Indonesia. So you need to increase revenues. And that does not necessarily mean you have to increase tax rates. That could, happen through a broadening of the tax base, for instance, having fewer exemptions in terms of value-added taxes. It could also mean having, reducing some subsidies that we don't think are very helpful on fuel, for instance. And that would all, raise revenues without necessarily raising tax rates. Now, raising tax rates, I would say, is not off the table. I think, the first step should be to broaden the tax base. But, when you have a ratio of tax revenues of 10% to GDP that is so far below what we observe in other countries, including other Southeast Asian countries, that there's also room to raise rates a bit further without necessarily hurting growth. Thank you.
Thank you. This is for Vietnam. What is the impact of the State Bank of Vietnam bailing out the Saigon Bank in 2024?
Okay, so the difficulties of the Saigon Bank were related to difficulties in the real estate sector. At the time when the difficulties arose, it was clearly necessary to bail out this bank to prevent further damage to the financial system. But maybe what is more important than the specific event is the kind of vulnerabilities that it reflects, and that bears some lessons for the future. We think that there is clearly scope for more competition and also more transparency in Vietnam's financial sector. And as I mentioned in our recent economic survey that we published on Vietnam, we elaborate in more detail how that could be done. To our eyes, it has to do with the way that monetary policy is conducted in Vietnam. Moving towards a more price-based conduct of monetary policy would certainly improve the scope for competition in the financial sector, competition among banks, which is currently weak given that individual bank level credit targets are being defined. And that would certainly also improve the prospects for financial stability going forward and reduce the probability of such an event occurring again.
For Thailand, what should be done about Thailand's growing public debt burden?
That's a very relevant question. As you perhaps know, Thailand's public debt burden is around about 65% of GDP and is heading towards the ceiling that is imposed under Thailand's fiscal rules of 70% public debt to GDP ratio. As Jens underscored, in a way, what we always emphasize at the OECD is that government should pay attention to the efficiency of public spending. And we very much urge Thailand to do that in our upcoming survey of Thailand, which is going to be published next Monday. However, in addition, even with full attention to the efficiency of public spending, Thailand is among the countries that should be looking towards a structural increase in its fiscal revenues. And in particular, we would underscore the scope to increase the amount of revenue that Thailand receives in value-added tax, VAT. This could include both increasing the rate of VAT, which is relatively low, and also by broadening the base of VAT. In other words, making VAT apply across a wider range of goods and services. Other areas where we see scope for increasing tax revenues are in income tax, where we think the thresholds for personal income tax seem to be rather high, and lowering these would also raise more money for the Thai government. All these points are again underscored in our upcoming report. Thank you.
Thank you. Next, we have Malaysia. What is the basis of continued moderation of Malaysia's GDP growth over the next 2 years?
So the way that we would characterize our growth projections for Malaysia is, in fact, fairly strong growth. It's true that when you look at the numbers, simply mechanically, there's a decline in the growth number for between 2025 and 2026. 2025 has been buoyed by some of the developments that occurred in the earlier part of this year and then also in the third quarter. So that has implied strong growth for 2025. But in our growth projections of 4.4 and then 4.1 still look very solid for Malaysia and are probably more aligned with the growth potential of the economy than what we saw in 2025. Factors that I would mention that could explain to some extent why the strong growth momentum that we had in 2025 will diminish to some extent include fiscal consolidation, which is clearly necessary, but will have some impact on domestic demand. And then a particular important part of that is the gradual withdrawal of fuel subsidies, which we also think is a very important measure for Malaysia to pursue, particularly in the context of trying to improve the efficiency of public spending. But that will gradually have some impact on the purchasing power of some households, the way that it's been structured. This will at the outset only affect higher income households with a lower propensity to consume. But we think that eventually this may have some impact, but at the same time, it's an important measure to be undertaken, and it could be mitigated. The economic effect of it could be mitigated by strengthening transfers to vulnerable parts of the population.
Regarding Vietnam, what are the projections should the monetary policy remain unchanged, but tax reforms and tariff application follow through projections in 2026?
So, in fact, we have a tax reform factored in. We think that, or we follow the announcement that the reduced VAT rate will not continue forever and that it will be phased out towards the end of 2026. This is going to have some effect on domestic demand, but that is already factored into our projections. And overall, on monetary policy, we see that there is scope for some tightening in case inflationary pressures turn out stronger than what we project currently. A bit of that is already factored in, but we think that it's important to be particularly vigilant in this case.
Simply put, how do you view the impact of the US-China trade war on Southeast Asian and Indonesian economies, specifically regarding the dumping of Chinese products that have lost their market outlets? How should countries respond?
Maybe I can take this question and respond with a broader view on the region. I think really what matters here is that Southeast Asian economies undertake every reform that they can to strengthen their own competitiveness. And this is really domestic reforms. And this comes back to the questions that I mentioned with respect to opening up the parts of the economy to more competition, particularly with respect to services sectors. We know how important services sectors are for the downstream competitiveness of manufacturing activities. And on this front, really, Southeast Asia still has a lot of scope to implement reforms that could lead to improvements in competitiveness. And I think the best way to respond to pressures from outside is really to improve your own competitiveness and do the kind of reforms that we know will yield dividends when it comes to export competitiveness.
For Thailand, how can Thailand improve its long-term performance?
As mentioned in my short presentation, one of the avenues in which Thailand can improve its performance is by making its regulation more competition friendly. I think in the chart that my colleague Jens showed, Thailand is really at the upper end of the scale in terms of having overall restrictive competition market regulation. In our upcoming survey, we, for instance, underscore the scope for strengthening regulation and legislation in competition policy, and also around the way in which state-owned enterprises are run. And finally, we also emphasize the scope that Thailand has to make for better interactions between government and business. In other words, less red tape, more efficient services provided by government, and where possible, paring back regulation and legislation so that businesses can operate more smoothly. Thank you.
For the Philippines, and excuse me if you've already addressed this, do you think that the deepening probe into the corruption in the Philippines could help robust or rebound the economy? And how important is it to address?
Okay, so I think that in the short term, of course, this corruption scandal and slower public investment related to it, because some contractors, will face more stringent controls in the short term. There will be a lot of public officials who might be reluctant to start new projects because there will be very stringent controls in the short term. So in the short term, the corruption scandal is, of course, weighing on growth. But as I said before, I think, resolving the corruption scandal and, providing more transparency in public procurement is actually very important in the long term and in the medium term. More transparent public procurement will improve investor confidence. And I think in the long term, if the scandal is addressed in a rigorous way and public procurement becomes more transparent, then this is actually an opportunity to improve the investment climate in the Philippines and can actually help to raise growth in the long term. So in the short term, it will weigh in growth, but if the scandal is resolved in a rigorous way, then there might actually be a payoff in the long term.
Okay, this will be our last question. How does the OECD assess the medium-term impact of the US transshipment tariffs on ASEAN economies? And do these measures lead to an increase in value added in the industrial sector? Or do they instead result in a decline in foreign direct investment that adversely affects overall manufacturing performance?
Okay, so we view this question of the transshipment tariffs particularly as a risk because it's not really been defined yet, and it's not even defined how a transshipment would be measured or what exactly a transshipment is. We see some concerns, of course, around some diversion of trade following differences in tariff rates, but we also see that in fact the share of domestic value added in all of Southeast Asian exports has increased over time. So transshipment is maybe a part of the story, but it is certainly not a particularly large part of the story, and particularly when we look at the case of Vietnam, for example, for which such tariffs could pose a particular risk, we see that in fact the share of domestic value added in Vietnam's exports has really increased over time and is not at the level that you would think would particularly justify stronger tariffs on Vietnamese exports. But again, this has not really been defined in the policy sphere, so we're just flagging this as a potential risk, as it has been announced as a potential source for additional tariff measures to be put on Southeast Asian economies.
Thank you, everyone, for joining us today. We hope you enjoyed our presentation.
Thank you. Bye.
Thank you. Bye-bye.